Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will turn back to the overall market sentiment. We've seen a very interesting dislocation recently between the equity market performance versus the bond market, as well as the currency space and commodity market. So a couple of interesting things that we focused on right now. We do have a couple of interesting events that can spark some possible risk on and risk off flows this week. So join me now to the video to see exactly how we can prepare for these events and hopefully trade them in this upcoming week as well. Taking a look at the current baseline for overall market sentiment, if we just look at the equity markets in the US, like the S&P in yellow, the Nasdaq in blue, and the Dow Jones in red, it doesn't really seem that the market is all too concerned about the recent negative data we had, and all too concerned about the biggest recession in almost a century. Now, given everything that is going on, it really doesn't make a lot of sense to have seen stocks to put in their best month in more than 3 decades. But looking at the performance, it does seem that the investors are starting to choose to look through the 2020 devastation towards greener pastures in 2021. However, this is a very overly optimistic view, given that the recent economic data and earnings releases we've seen has been very bad. Starting with the data, it does suggest that the world economy needs to be prepared for a much longer and slow recovery than currently anticipated. Just looking at something like the jobs losses in the US alone, the numbers are just absolutely humbling that we've seen recently. And it is true that a lot of bad news was already priced into the numbers, but something that is arguably not priced in yet is the transmission effects of all of that job losses. That'll mean mass defaults on credit, as some businesses will never open their doors again. So the expectation of just a sharp recovery in all of those job losses looks very slim at this stage. Taking a look at the global economy as well, if we look at the Bloomberg Global PMI tracker, we can get a very visual idea that this downturn is definitely not limited to the US. It is just massive on a global scale, the sheer downside that we've seen recently. Turning to earnings, if we wanted to sum up how the market reacted towards Q1 earnings, we could use the phrase called better than expected. We saw that happen over and over again during this Q1 releases, where data came out slightly better than markets had anticipated. Now, with the vast amount of companies actually refraining from providing any type of forward guidance, this too seems very overly optimistic from the market, as plenty of downward revisions will most likely be in store for the majority of companies in Q2 when the full impact starts to show up from the nationwide lockdowns. Now, despite all the negatives we've seen, the equity market has chosen to focus on the positives, such as unlimited QE and of course the phased reopening of the economies around the world and the recovery that is to follow from that. Now, taking a quick look, we do get a very bleak picture painted by the most recent Bloomberg US economic tracker recovery tracker. It seems that the equity market is putting a lot of faith right now in the Federal Reserve and other major central banks in order to keep the boat afloat, because so far we haven't really seen anything to be positive about in terms of the actual recovery. Now, apart from that, we have seen strained relationships between the US and China take center stage again over the last couple of sessions, as the US administration has lashed out against China due to how they handled the coronavirus pandemic. But in true pump and dump fashion, we did see officials managed to give the markets another short-term reason to be positive, with reports saying that the two sides had a very constructive phone call, and further reports saying that there is a possible meeting coming up between the two sides in this upcoming week. Now, something that is interesting that we need to take a look at is that the overall euphoria of better than expected has largely been limited to the equity market itself. If we quickly take a look at this chart, we have the S&P in yellow overlaid with the US 10-year Treasury yield, as well as the Bloomberg Commodity Index. Now, you don't have to be a rocket scientist here to see that there's an obvious dislocation and disconnect between recent equity market performance as well as the rest of global macro markets. Now, the recent negative data has seen rates markets actually start to price in negative interest rates for the first time in the US, with 2-year yields hitting record lows in this week. Now, even the currency markets have been very wary to price in the so-called V-shaped recovery that we're seeing in stock market anticipation. Apart from a few clear outperformers like the Aussie dollar, of course, the major currencies has been largely more range-bound in the last couple of weeks, mostly driven by a range-bound US dollar seen here at the right at the bottom. Now, this has largely been driven by the broader market struggling to really price in the economic gravity and uncertainty, despite a clear divergence across the macroeconomic sphere. Now, looking at this upcoming week, there's a couple of events we need to keep track of that can provide some short-term trading opportunities in line with that overall market sentiment. First one, as we said, US-China tensions. We need to watch this relationship very closely. There is a lot more at stake right now compared to when we had the trade negotiations in 2019. The world right now is angry, and rightly so, and any long-winded negative to and fro between the US and China will be a negative input for market sentiment. If we compare how the US and China handled the 2019 trade negotiations, we saw them make U-turns in a moment's notice and change their minds across the board again and again. So we need to be prepared to go both ways in terms of risk sentiment, sensitive trades if the opportunity arises. And this week's planned meeting between officials will be important for us to watch. Looking at economic data, we'll also get a further idea of the extent of the pandemic slowdown with key economic data points coming up this week. We have US CPI, retail sales, also industrial production. We have also UK GDP, German GDP, and then China industrial production and retail sales as well. Now, the most important events in line with overall market sentiment will be US CPI and retail sales, followed by the Chinese retail sales. Inflation in the US is expected to tick lower, but Wells Fargo did argue that the total extent is very difficult to quantify right now, as there's lots of push and pull factors on prices, such as longer waiting time in terms of supply deliveries, which should in effect keep prices elevated. But we've also seen falling commodity prices, which is of course a downward input in terms of CPI. Looking at retail sales, it'll be the more important data point, as markets are expecting another record-breaking low point, as the full brunt of the lockdown is set to show up in the April data. Another key thing to watch, as we said earlier, is the yield market or the bond market. The US 2-year yields fell to a record low as some markets start to price in negative rates for the US. Now, this happened in a week where the risk zone saw multiple risk on days and traded mostly positive. So that is very interesting. The move low in yield shows us that the bond market, at least, is still pricing in more downside, which is in stark contrast to what we've seen in the equity market. So further dislocations between yields and equities will become more and more important, especially if yields start to move closer to 0%, and is something we want to keep a very close eye on in this upcoming week. Also, another focus point will be the reopening of the economies, especially the US. The risk for risk assets in this reopening is if we see a massive increase in case numbers as well as fatality numbers. That'll put governors as well as the US government in a very difficult position, as they would need to weigh the importance of restarting the economy with the obvious risk of further spreading of the virus. Then, of course, we have Fed Chair Powell as well, coming out on Wednesday with a speech. The market will be very interested to hear what he has to say about the recent moves we've seen in terms of the pricing in for negative interest rates. We know from recent comments that the Fed really isn't interested in negative rates. So a further commitment from the Fed that rates will stay lower for longer, especially as long as possible, despite moves in the bond market, should provide more solace for risk for the recent risk rally. So definitely something we want to pay attention to. Then turning to possible sentiment shifts, starting with the dovish ones. Risk sentiment will turn a lot of its focus this week on the US-China relationship, especially with that upcoming meeting. Now, if we use the trade negotiations of 2019 just as an example, we are in for another week of possible contradictory comments, both positive and negative. And this week's comments of a phone call and a possible meeting has seen another risk rally, and any breakdown in those talks in this upcoming week or further negative comments could spark another negative move in risk assets. Turning to economic data, especially the US retail sales and CPI, that could spark some risk off flows as well. Much lower numbers, of course, than currently expected could spark negative risk sentiment, as US consumers, specifically relating back to US retail sales, is the backbone of the US economy. If we see a major miss below the market's minimum expectation, that should be a more negative input for risk assets. Just keep in mind, we have seen markets largely discounting negative data recently, so it'll be interesting to see how they react with regards to the retail sales. Turning, like we said, to the bond market as well. The move in yields this week is trying to tell the market that all isn't as rosy right now as the recent risk asset rally would suggest. Now, if the bond market is right, we might see that the risk rally might be running out of steam, and further moves lower in US yields might be a catalyst that we need to take note of. That is also where we can see CPI coming in. Remember, as deflationary expectations in the US start to grow, the attractiveness of something like US bonds, the US dollar, and even gold should theoretically rise, as lower inflation would lead to higher real rates and higher real yields. So keep in mind, however, as yields also start to push lower due to further expectations for negative rates, the impact of low inflation might be mitigated. So just keep that in mind. And then we also need to keep our close eye, of course, on the coronavirus case numbers and fatality numbers, as more and more US states as well as other economies around the world start to ease their lockdown restrictions. Now, a drastic escalation or jump in case numbers and fatality numbers should see risk off flows, as it would pour some cold water on the hopes of a very fast and sharp economic recovery. Looking at some possible hawkish sentiment shifts, US-China trade relations should see a continuation of the recent positive market sentiment if we see further reconciliatory comments as well as positive comments coming out from that upcoming meeting. In terms of economic data points, we do have an interesting one in the form of jobless claims this week. The obvious downtrend in terms of the recent claims numbers hasn't really gone unnoticed by market participants. And if we do see a major drop or a further continuation of that trend to the downside, that can also spur some positive risk flows. This also brings us to the US and Chinese retail sales data as well as the industrial production data. As the economies are starting to open up in May, most analysts as well as economists expect that the brunt of the negative data will fall in the April numbers. Now, April can be viewed as the bottom for most of the economic indicators, apart from, of course, the labor data that is expected to inch up. Thus, any much better than expected retail sales data from the US as well as China will probably be seen as a market positive, as some would argue and interpret that to mean that the worst is now behind us and the worst wasn't actually as bad as we initially expected. Also, China is basically the first country to have come out of lockdown. Their data is being watched by many market participants as a possible template of what might happen to the other world economy. So if retail sales in China surprises to the upside, it should give markets something to be more positive about and should be more supportive for risk assets, especially the Aussie dollar with its very big dependency on China as its main export partner. Also be on the lookout for further progress being made in defeating or preventing the virus. Any breakthroughs with treatment or prevention will likely be welcomed by markets as another possible catalyst for risk on flows. Then possible currency pairs to trade in line with a sentiment shift. As our attention is turned to risk sentiment for this upcoming week, we would look to pair typical risk sensitive currencies with each other in the case of a risk sentiment shift. Now, if we see a strong risk off flow in the markets and developments that shift the risk tone negative, we would expect that to be supportive for the safe havens, the Swiss franc, the Japanese yen, and the US dollar. And we'd expect that to weigh on the high beta currencies like the Aussie, the CAD, and the Kiwi. In the case of a risk on flow, we would expect just the opposite. We would expect that to be supportive for the high betas like the Aussie, the Kiwi, the CAD, and expect that to weigh on the safe havens like the Swiss franc, Japanese yen, and the US dollar. So the highest probability currency pairing would be to pair a safe haven against a high beta, and vice versa, depending on the type of risk flows. Now, something to keep in mind is we do have a few very important economic data points lined up for the Aussie as well as the Kiwi dollars this week. In Australia, we'll see the latest jobs report, which could be enough to calm that recent Australian dollar rally that we've seen, so keep that in mind. Also turning to New Zealand, we have the RBNZ policy meeting coming up, and they are likely to announce an increase in their QE program. And if that happens, we can see, depending of course on forward guidance, we could see that weigh on the Kiwi or be a supporting factor. So definitely something we need to consider. Now remember that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can of course change throughout the week. So make sure that you evaluate that short-term sentiment shifts before you take any trades this week. Now looking at any possible economic news that we can trade into, as the main focus for this week is on the risk sentiment. We know risk sentiment can change from hour to hour, from session to session, so we won't be interested in trading into any of these upcoming events, but we could look to do any significant changes in the sentiment following some of these events for the best possible trading opportunities.